Hi, this is Michelle LaBanca with Compass in New Orleans, Louisiana. There's been some discussion over the last few days about 50-year loans being introduced as a way to make homeownership more affordable. On the surface, this may sound like a creative solution. They would stretch the term, lower the payment, and suddenly now more people can qualify. But here's the truth. These loans may look like they're going to help, but in the long run, they could hurt consumers financially and potentially make the housing crisis even worse. Let's talk about why. So, why is this suddenly back up for discussion? And who benefits the most? The answer should not surprise you. It's banks and mortgage lenders, home builders and developers, institutional investors, and REITs, or real estate investment trusts. For lenders and banks, it's the obvious. The longer loan term limits mean a significant increase in the total interest paid over the life of the loan. For builders and developers, and for folks like me, realtors, quite frankly, it would expand the buyer pool. By lowering the monthly payment, a 50-year term creates an artificial affordability. More people can technically qualify for a loan because lower payments means those who may not have qualified previously due to debt to income ratios now may actually be approved. For investors, longer loan terms keep home prices high, which benefits large investors by making renting more common and by keeping their rental income steady. So let's talk about the equity problem. With these ultra long loans, you're barely touching the principal for the first 10 to 15 years of the loan. The majority of what you're paying goes towards interest, not ownership. That means you're building equity at a crawl. If the market shifts even slightly, you could owe more on your property than what it's actually worth. And that's a dangerous position for any homeowner, especially if something happens suddenly and you need to relocate for work or you need to sell before you've had time to gain real equity. Life happens. Equity is what allows homeowners to move up, to refinance, and to weather market downturns. But with a 40 or 50-year mortgage, you're stuck in financial quicksand for over a decade before that safety net even begins to form. Some might argue that longer term loans could help people in ultra expensive markets. Think San Francisco, New York, Los Angeles, or it could potentially help buyers early in high earning careers. But here's the thing, there already are specialty loan products built just for that. There are programs available like physician loans, professional loans, and even some jumbo ARM or interest only products that give qualified borrowers temporary flexibility while recognizing future income potential. They don't require a 50-year repayment timeline. So even for those with strong earning potential, there are smarter, more responsible options rather than locking yourself into debt for half of a century. Let's look at a side-by-side comparison of a 30 and 50-year mortgage. The lower monthly payment is the biggest selling point of a 50-year loan. However, affordability isn't about the size of the payment. It's about the total cost and about long-term stability. So while that payment for a 50-year loan might look like a few $100s cheaper each month, you're actually spending hundreds of $1,000s more overall. And that's not affordability. That's an expensive debt disguised as a deal. Imagine being in your 70s or 80s and still paying on your original mortgage. For many people, that's exactly what these ultra long terms could potentially mean. Instead of retiring debt free, you're still sending payments to the bank. And with slower equity growth, you still have fewer financial options if something changes. That's not the kind of stability homeownership is supposed to bring. There are better ways to improve housing affordability. We could build more homes, specifically starter and middle market options. We could modernize zoning and permitting so more housing can be built where it's needed. We could increase density limits as well. We can encourage responsible lending, not just longer debt. We could offer short-term tools like down payment assistance or temporary rate buydowns. These help families own a home sooner and not pay forever. And most importantly, a big piece of what we do is educate buyers so they understand the long-term cost of financing decisions. True affordability comes from smart policies, sustainable prices, and financial literacy, not 50 years of payments. On paper, a 50-year mortgage might look like an easy fix, but in reality, it's a financial trap. Homeownership should build wealth and stability, not keep you in debt for a lifetime. If this video helped you understand what's really at stake, please hit like, subscribe, and share it with anybody thinking about buying a home in the near future. The more informed we are, the better we can protect our financial futures. And that's what I'm here for. Thank you.